Good evening, Western Standard viewers, and welcome to the first edition of Hannaford. In the weeks to come, we'll be talking to prominent Canadians who make news, do things, and think great thoughts. And we want to start this week with a man who is probably Canada's most distinguished economist. That would be Jack Mintz. Certainly when I was at the PMO, I always used to think, isn't it great that Dr. Mintz always gets his phone calls returned. And then later I found out that actually it was our office that was calling him. So it gives you some measure of the authority and the scholarship that lies behind the Mintz name. Many of you have seen his work in print since. He's been quite prolific. Jack, it's great to have you here.
Well, it's my pleasure, and I'm very happy to join your inaugural podcast.
Thank you, Jack, and thank you for doing that. Look, maybe I could ask, just by way of a start, does the present government ever ask you what you think?
Well, it depends which part of the government. I do hear from some of the departments with regard to some issues they may want to get some background on from me. So I do have that kind of communication, but I don't really hear from the PMO. I think I've been kind of dismissed by the Liberals.
So, you know, the finance minister does not have you on speed dial?
No, for sure not.
I think it's all of our loss that is the case. Jack, I'd like to talk to you about two things today. One we talked about earlier was the critical tax theory, which sounds wild. But before we go there, maybe we could just talk about what has happened with the capital gains tax. It strikes me that an awful lot of people find the idea of a capital gains tax something that they either don't think they need to think about, or maybe it's somebody else's problem. But recently, the finance minister, Freeland, raised it significantly. What has she done? What is she trying to achieve? And is it going to work?
Well, I think, first of all, she wanted more revenue to balance, well, at least try to keep her deficit from not getting higher than $40 billion that was promised this past year as one of the objectives. And of course, that included delaying expenditures, but it also included bringing in this new capital gains tax increase. And in fact, people were warned about it in the April budget that it would come in on June 25th, which it has. And of course, that would give people time to sell assets between the date of the budget and when the date of implementation, which of course would give more revenue to the government in the current year. All very helpful for the deficit, for sure. So I think that was a primary objective. But in terms of tax policy terms, I think the idea is one that actually I think is important to consider, because we have to remember at one time in Canada we didn't have a capital gains tax. This was before 1972. It was brought in 1972 in a major tax reform at that time. And the reason we brought in capital gains taxation was that people would try to pay out income in the form of dividends and other, pay people out in the form of capital gains rather than other forms of income like dividends, in order to avoid taxes on dividends and employment income, et cetera. And so to provide more balance in the system, the capital gains tax came in, but in recognition that actually capital gains is already taxed once at the corporate level. In other words, when companies reinvest their after-tax profits, that causes the value of the firm to go up. And of course, if the corporate tax rate is higher, the less that capital gain is going to be for investors. So that was the logic for bringing in a capital gains tax rate that was lower than the ordinary tax rate, and in fact, roughly parallel with the dividend tax rate at that time.
Now, Jack, we're talking a lot about companies reinvesting, corporations paying taxes, but I have a feeling that ordinary Canadians are going to feel this too, even though the finance minister says that it's only a very small and rarefied group at the top of the income charts that will. You, I believe, have done some calculations on how many people will be affected by the capital gains tax and the kind of things that are likely to be subject to capital gains, small businesses, family cottages, those sorts of things. Can you just expand on what it means for ordinary people who may get a once-in-a-lifetime capital gain? And how many are there?
Well, I think, first of all, the minister was very wrong in the way that the data was reported, where she said only 1.4% of taxpayers will be affected. This is kind of gives an idea that the people who get over $250,000 in capital gains, because the new rate applies to only capital gains in excess of $250,000, and it was the impression was given that these people tend to get capital gains like that every year. And so it's the same small number of people that are going to be affected. That was totally wrong, because on a lifetime basis, there are many people that get more than $250,000 of capital gains in a year, but they may only do it once or twice in their lifetime. A good example of that, of course, is someone who buys a cottage in 1980, and let's say the cost of that cottage was $100,000, and then they sell it for 45 years later for let's say $500,000. So there's a capital gain of $400,000, but some of that is just simply due to inflation, and it's not. And often this kind of money is what people use for their retirement as well, just like all the money that's put into a pension fund or an RSP. There's a huge amount of money that pays out an annual pension every year. So it's when you actually look at the data, and I did this, there's a lot of people who, without the $250,000 in capital gains, and this was just in the recent data, if they didn't get over $250,000 in capital gains, their actual income, taxable income, half the population was below $100,000. So a lot of middle class people were affected. In fact, 10% of the population would have only had $18,000 in taxable income. And that might be surprising, but I'm not surprised, because there could be people who died leaving an estate that's subject to the capital gains tax at that point, and they don't have a lot of income at that point. And it also could be farmers, for example. They tend not to have a lot of money every year, not a lot of cash. But the one thing they do have is land. And of course, when they die, or if they sell their land, and that's the time when they get a lot of money through, by selling their property, which is, of course, part of their retirement income when they do retire. So there's a lot of middle class people that are going to be affected. So I found, I was given some data that Statistics Canada has put together. And what it showed is that in 2011, for example, there were about 44,000 people that had capital gains more than $250,000. However, out of that 44,000, 2/3 only claimed capital gains of that amount in that year. In the next 10 years, they didn't claim it at all. So 2/3 of that 44,000 people only claimed capital gains more than $250,000 in just 1 year, and had less than that in other years. Or didn't have any didn't have capital gains that would go over the $250,000 mark. And so I did a calculation, sort of taking into account the whole population, to find how much on a lifetime basis people actually do pay this capital gains tax rate that will now be over $250,000. And I calculated, and this is a rough estimate, I admit, because I didn't have all the data I would have liked, but I estimated about 1.25 million people are affected by the gains tax increase for this year, not just 44,000 people.
So to put this in very human terms, I mean, you mentioned the cottages, you mentioned the transfer of land. I mean, these are things that people do, and there's nothing wrong with that. But it does sound like we're already talking about people who are wealthier than the average. Let's take the case of a person who starts a small business manufacturing something in an industrial estate in southeast Calgary. Starts it in 1980 with a loan from his dad, works hard at it for 45 years, wants to sell out so that he can retire in some comfort. And that business that he built that was worth nothing when he started is now worth $1 million. He is going to be giving, what, 2/3 of that to the government? Is that really how this is going to work?
No, it's not 2/3. So the way the capital gains tax increase or tax operates current under the under the pre-June 25th rules is that when a person sells their property, they calculate the difference between the sale price and the original cost of buying that property. That's the capital gain. Then in the previous, or under the current previous June 25th situation, 1/2 of that gain is included as taxable income and then subject to the tax rate. And let's say if you were at the top Alberta rate, for example, 48%, then the capital gains tax rate is 24% on the total capital gain. So in case of let's say a person that has $1 million capital gain from selling a small business, he would pay about $240,000 in capital gains taxes under the old system. Under the new system, because the first $250,000 of the capital gain is still taxed at only 1/2 is included in income and taxed at the 24% rate. However, the next $750,000 is going to be taxed at the capital gain at an inclusion rate of 2/3 instead of 1/2. So 2/3 of $750,000 is $500,000, and the tax rate is 48% on that. So that means a person will end up paying very close to $250,000 in capital gains on the $750,000, and he will pay on the $250,000. He will pay $125,000. So when you add the two up, you can see it's a very significant increase in the amount of tax to be paid because of that extra tax that's going to be on capital gains more than $250,000. And so that's the case of that small business owner, for example.
So now I believe that the finance minister makes the case for this on the basis of intergenerational fairness. Is there any fairness in this that you can see, Jack? I mean, is there a positive side to this? Because it sounds outrageous.
Well, it's kind of, first of all, there was a huge mistake again made by the minister and the budget in the way they discussed the issue. They were comparing the capital gains tax rate, let's say that someone pays on capital gains from let's say their from selling their business assets or whatever property, and they were comparing that tax rate to, let's say, the tax rate on employment income. So let's say in Alberta the tax rate on employment income is 40%, just to give an example, and the capital gains tax rate might be, under the old system, would be 20%. And they would say, oh, that's very unfair. However, what was not mentioned was that capital gains were already taxed under the corporate income tax. And in fact, there's a very close relationship between the dividend tax rate and the dividend tax credit and the capital gains inclusion rate, where those are provided in the system as a offset for the corporate tax that's already been paid on the profits before they're distributed or reinvested. And so the capital really the capital gains tax rate really is not just the personal rate, but you have to add in also the corporate tax that was paid in addition to that.
Right.
And that could actually bring it up to 40%. So there was no particular unfairness in that sense. Now there is another aspect to this, and that is capital gains taxes are paid on the actual nominal income without any adjustment for inflation. if we made an adjustment for inflation, the actual gain is much smaller because people have lost value of their money because of inflation. The purchasing power of their money has fallen because of inflation over the years. And so the actual capital gains tax rate on what you might call real capital gains after you adjust for inflation is going to be significantly higher than the number that's often given in comparison. The way the number is normally reported, like 25%. The real rate could be like 50% or 60%, depending on how much of the gain has been reduced by inflation. So that is also not included in the way of thinking about how much tax is actually paid on capital gains.
Jack, I find it absolutely astonishing that a government with all the resources and advice at its disposal could make a mistake of that magnitude.
Actually, yeah, I could add just one more
Sure.
point to this. With regard to intergenerational equity, it's interesting that no one has actually really put this in these terms. But when people pass away, or as they get close to the end of their life, they gift their money either as donations or they give it to their children. And so there is intergenerational equity in the sense that people do pass on their wealth to the next generation, but or to the people that they want to donate to. And that's what you might think of as individuals making that decision for themselves, who they want to support. And of course, there's a lot of people that do donate their property, not just give it to their children. When the government taxes the property, as in the capital gains tax, for intergenerational equity, what they are doing is making the decision for the people about who should benefit from those taxes. And of course, I think it's one thing that Canadians would support if the money was going into something like healthcare. But as we know with this government, at the federal level, there's been a huge expansion in the public service. There's been huge amounts of money given out to contracts. Some of it looks like it was corrupt in the way that it was done. And there's been a lot of grants paid out, perhaps to people we're not sure we really would have wanted to give those grants to. And so is there really generational equity that's being enhanced when you have a government that's using the money in ways that has nothing to do with intergenerational equity, but instead for politicking in terms of getting more support from their base?
I can feel another column coming on, Jack. Jack, you mentioned inflation. They say it's 2.7%, but it doesn't feel like 2.7%. Why is that?
Well, inflation, when we talk about inflation, we often talk about the current rate, which is 2.7%, which is how much consumer prices have gone up over the past year. Let's say, if we're talking about June 2024, then we look at the rate from July of 2023, consumer prices from then up until the end of June, and that would give us a year-over-year inflation rate, like 2.7%. But people aren't looking at inflation rates. The Bank of Canada does. In fact, they should do, because they want to see how the trend in inflation is changing, because that's a guide to their interest rate policy. But for individuals, what they care about is the price level. In other words, the cumulative change in prices over time. And of course, since beginning of 21, after the pandemic, prices have climbed up quite a bit. Food prices have gone up over 20%, shelter prices over 20%, gasoline prices 60%, etc. And it would be one thing if people's incomes kept up with inflation, but that's not what happened for several years. Now, inflation is a little bit below the wage increases, but that's only been in the past year. So when people look at their position today and they think about what it was like, let's say at the before the pandemic, they feel their money is being stretched. They don't have as much money to spend because prices have gone up so much more than their incomes that they are unhappy as a result. And so it's a past. the cumulative change that matters to people, not the actual inflation rate when it comes to their budget.
Jack, if a man was, or a woman was earning $100,000 a year in the year 2021, what would they need to be earning today to have the equivalent purchasing power that they had 3 years ago?
I've calculated that number, and I'm not sure if I remember it correctly, but it is something in the 15% range or 20% range.
Really? Wow, that's terrible. Okay, Jack, there's one other thing that's buzzing around at the moment. That is critical tax theory. We've heard of critical race theory, where I guess the idea is that the system is rigged so that certain groups can do well and other ones don't, and that's not fair. Now, what is critical tax theory? I see the Canadian Tax Council is looking for learned papers on it. What would you tell them?
Well, actually, it's a good question. In fact, in 1 week, I had 2 requests with regard to papers. Or, one was from the Canadian Tax Foundation, which is an excellent place, and their Canadian Tax Journal runs policy forums, and they wanted to do a policy forum on critical tax theory. But I also got a message from Tax Notes, which is a major U.S. publication for practitioners, and many people get around the world. In fact, I get Tax Notes International, which is one of their 3 publications, and it goes to like 50,000 people in terms of tax practitioners, and they were also asking for papers on critical tax theory. So I thought, gee, I don't know a lot about this, so I decided to read a whole bunch of papers on critical tax theory. And what critical tax theory basically says is that, we look at the way we tax people according to differences in income, but income is not the only thing that matters in terms of looking at differences in people. There's other factors that are important, and I think that's fair enough. I think most people would agree with that statement, but then they would make the jump, and this is where I find it very difficult to jump. But then they say, well, they differ according to race, sexual orientation, gender, et cetera. And they talk about the need for social justice. When I say there's a jump, it sort of already goes into a certain direction, which has been very common in critical race theory, that looking at certain people that are identified as being disadvantaged, although there's a lot of other people who are disadvantaged that may not fall in those categories, but that's the point. But that's what they do. And so then they start looking at different policies in terms of whether it's disadvantageous to certain races or gender, et cetera. And we should be fixated on that and make changes in terms of tax policy for that purpose. So just to take an extreme case, which I haven't seen anyone really argue with, but if I was going to ask a question of my students, if you're applying critical tax theory, should we have a different income tax schedule for, let's say, blacks versus Asians and whites? Where maybe the blacks would get higher exemption levels and lower marginal tax rates according to brackets compared to, let's say, whites and Asians who do better. Is this an implication of critical tax theory?
Now, you said that this was an extreme example and that nobody has actually floated that yet.
Yet.
Do you see that coming? And can you give us an example of something that has been proposed?
Well, there has been, some of it is actually kind of logical in the sense that I wouldn't even need critical tax theory. I just need good old tax principles to make an evaluation. So some of the discussion, especially in the United States, has been, let's say, higher property tax payments made in certain neighborhoods, like black neighborhoods, and the kind of services they get are a lot less than what they're relatively paying in terms of property taxes. And that certainly is an unfairness. In fact, it was Portuguese living in that neighborhood. I would say it's unfair to the Portuguese too. And in fact, basic tax policy would say if you had proper benefit taxation, then you would want some alignment between municipal services and property taxes. And so I think that is just, to me, very sensible tax policy without getting into critical tax theory. And it would apply to anybody. It wouldn't just apply to certain designated groups. But then again, I've seen some proposals saying, for example, reductions in corporate tax rates are unfair to blacks and to let's say disabled people or whatever, and that I think assumes something about who pays the corporate tax, which is a fundamental area of disagreement by economists. Many will say that actually a lot of the corporate tax is shifted back onto labor, not onto capital owners, especially in an open economy, where capital will flee to other countries if you try to tax it. And so therefore, who ends up getting hurt by the corporate tax are the people that work, because they end up getting lower wages or getting fired from their jobs. So if one believes that story, and there's some significant evidence that story applies to many countries, at least to a certain extent, then that would suggest that it would be very bad for, let's say, certain races or disadvantaged people if you raise corporate taxes. But the critical tax people seem to assume that corporate taxes are, paid by the powerful, by the rich, and therefore should be raised. And to me, that's a wrong conclusion, especially given the data that we know today.
Well, last question then, Jack. Is the government of Canada, the present administration, looking at introducing separate tax rates according to ethnic or group identity?
I don't think so. I hope not. I would be appalled if they did, because I think that would go against, a sense of fairness amongst a lot of people. And again, I think it's because, income is, I think, a very good measure of how well someone is doing. And so they can understand why rich people pay more tax than poor people. But I think they would have a lot of difficulty to say that certain groups in society should pay less tax than other groups.
I hope that they would, Jack. And I hope that you will be there in a position to give your advice if that ever should come up.
Right.
Jack, this has been a pleasure. Thank you so much for joining us. And for the Western Standard, I'm Nigel Hannaford.